Since 1972, the McIlvaney Financial Group has been a conservative, contrarian investment firm. With that mindset, they have created a multifaceted approach to portfolio management, offering a wide array of services including wealth management, a unique short fund, hedging through precious metals, and excellent educational resources. We have had David McIlvaney on our show multiple times because we respect his outlook, viewpoints, and recommendations. You really need to let them give you a much better understanding of what true portfolio diversification is. Just go to mcilvaney.com/Main Street, with Main Street all spelled out, to get introduced and to garner free information. Again, that's mcilvaney.com/Main Street to schedule your free 20-minute consulting session. I interviewed Michael Pento on Tuesday, and due to technical difficulty, after 14 minutes of the call, it was going very well, but Skype dropped the call, and it would not let me call back his business line. So then we had scheduling conflicts the rest of the week. So I want to release part of this interview, and then I guess I will just focus on trying to bring back Michael Pento in the near future. But this interview was recorded on Tuesday, and Michael correctly predicted that the Federal Reserve would raise rates again. But the main thing is, he says the Federal Reserve is hiking rates into a depression. Hi, everyone. This is Jason Barrick of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is president and founder of Pento Portfolio Strategies. He is author of The Coming Bond Market Collapse, How to Survive the Demise of the U.S. Debt Market. He's a follower of the Austrian School of Economics, the Free Market School of Economics, and he's a longtime financial industry professional and former trader. Uncle Michael Pento, thank you for joining me again.
Thanks for having me back on, Jason.
Now, Michael, I want to ask you about the Janet Yellen Federal Reserve. They seem still insistent on raising interest rates another 25 basis points. Why do you think they want to do this?
Well, if I dare to put myself in the mind of these people, which is a dangerous thing to do, but they're labor economists, so they are strict adherents of the Phillips curve. They're looking at the U3 unemployment rate as it continues to drop. They're biting their fingernails off and not sleeping very well, thinking and believing that inflation or even hyperinflation or intractable inflation is right around the corner due to the fact that we have a very low, historically speaking, U3 unemployment rate. That's the sole reason why they're doing it. But if you look at the facts are that the Fed is tightening monetary policy into what I believe is a depression, not even a recession, a depression, and I can explain that to you. So the Fed has been tightening monetary policy since December of 2013 when it began tapering. We already have 3 or 4 rate hikes projected. We're going to, I think, a 95% or 93% chance of a Fed rate hike tomorrow. And the yield curve, as they're doing this, the yield curve is starting to collapse. I think it will invert completely, or at least flatten out completely by the end of December 2017. And as they're doing this, we see asset-backed securities under duress, credit card loans, auto loans, student loans, C&I loans, commercial industrial loans are rolling over. We see industrial commodities are rolling over. We see oil rolling over, $45 a barrel on WTI. And as I mentioned, the 2-10 spread is at 85 basis points. We see even the job market, the household survey in May was a negative 223,000. Negative, let me say that again, a negative 223,000 jobs net. Household survey always leads the establishment survey. So if the Fed wasn't comprised of labor economists, then they would be looking at all the other data around them outside of the stock market, and they would say, wow, economic growth is slow, 1.6% for all 2016. Maybe Q2 will be 2%, but Q1 was 1.2%. So we have a very weak economy. We have money supply and velocity rolling over. We have all kinds of economic indicators telling us to stop raising interest rates, but they're not going to because they're fixated on that Phillips curve dynamic and the U3 number. Or if you don't like that explanation, Jason, maybe they just hate Donald Trump.
That may be a part of it. I mean, there's a lot of hardcore Democrats at the Federal Reserve. Janet Yellen is a very hardcore Democrat. But to add to your points there, Michael, I mean, there's thousands of retail stores closing. The Hollywood box office numbers are down more than 20% since 2013. So I don't see a thriving U.S. economy that's creating a lot of high-paying jobs with discretionary income for the U.S. consumer right now.
Well, you're 100% correct. And you look at all the tax receipt reporting numbers too. They scream the same thing. Even corporate profits are saying to me that the economy isn't that great. If you look at 2014, all of those S&P corporate profits, 2014 compared to 2016, it's almost immeasurable, the increase in corporate profits from 2014 to 2016. So there's no big corporate rebound. There's no huge surge in tax revenue. Nothing is telling us that this economy is growing quickly, not even the Bureau of Economic Analysis. So the Fed, again, is fixated on this unemployment rate. They're hiking into a recession/depression. I think it's the latter. As this is, by the way, is the MO of the Federal Reserve. This is what they've always done since 1913. So they lower lending standards, they create bubbles. The bubbles always require a massive amount of new debt and new money to keep the bubbles afloat. When the money supply gets cut off by the Fed raising rates and flattening out the yield curve, asset bubbles contract, and a depression/recession will always ensue. And we're very close to that happening. As I said, if you look at a trajectory between the Fed funds rate, you have to add 30 basis points to get the 2-year yield. So if the Fed funds rate is, say we have 1 or 2 more hikes this year at 1.5%, the 2-year note would be about 1.75 to 2%. And guess where the 10-year is? 2.2% as we make the recording of this interview. So if that trajectory continues, you can expect a flat or inverted yield curve sometime around the end of this year or the very early stages of 2018. And then the money supply gets cut off, asset bubbles will collapse, and we'll be in the throes of a recession/depression.
Michael, do you think the Federal Reserve can really meaningfully reduce their $4.4 trillion balance sheet?
Well, I think they can if they want to. I mean, so here's the issue you have to think about. So let's just say I'm correct, and the Fed continues to raise the Fed funds rate, and the long end of the bond market, which is very much determined by the rate of inflation, the rate of perceived and projected inflation. If that continues to collapse, what the Fed might do, these geniuses, these academic Keynesian geniuses at the Federal Reserve might say, hey, we have all this dry powder, this ammunition. The Fed's balance sheet went from $800 billion in 2008 to $4.5 trillion, where it sits today. They could say, hey, let's start aggressively selling mortgage-backed securities and longer-dated treasuries. And in that fashion, we can really force the yield curve higher. And I will tell you that if the Fed is raising rates and on the short end of the curve by raising the Fed funds rate, and also simultaneously aggressively raising interest rates by dumping treasuries into the bond market, then all the things I just mentioned, asset-backed ABS duress and credit card, auto, student loans, C&I loans, industrial commodities, oil, the 2-10 spread, the job market, all those things will get dramatically worse. So there is no easy answer for this. There is no way out of this predicament that the Fed has put the American economy in. There's a record amount of debt. If debt service costs rise, defaults will skyrocket, and we will have a depression. And they have no other alternative. If you say, well, the alternative is, hey, let's just aggressively dump treasuries into the bond market, which, by the way, the CBO says, not Michael Pento, the CBO says that our deficits are going to average $9.4 trillion over the next 10 years. That's going to come to 155% of GDP. And that presumes the baseline assumptions from the CBO assume no recession for the next 10 years, which I will say is virtually impossible, no tax cuts, and no dramatic rise in interest rates. So what I'm saying to you is if rates were to rise on this record amount of debt, then the whole insolvency condition becomes revealed. So chaos is coming, and I think it's unavoidable.
Yeah, I think the Fed has trapped themselves by not raising rates, earlier years before when they said they would. They didn't do it. And I think, now we have a lot worse stagflation coming in the near future. But, Michael, who would even buy all of these assets if the Federal Reserve said they wanted to unload tons of them? I don't even see a lot of demand for buyers of them.
Well, there simply isn't. As I said, first of all, I want to go on record saying that I agree with you, what you just said, Jason, and that if I had my druthers, the Fed would just raise rates anyway, just to get back to normalcy. See, what the economy needs more than ever is a cathartic purging of these excesses, excess home prices, excess stock prices. We have a record stock market today. If you look at home price to income ratios, they're at a record. If you look at total market cap to GDP, it's at a virtual record. So these asset prices must fall. And the best way to do that is to raise interest rates and collapse this bubble economy, and then have a stable currency, stable interest rates, and stable inflation on the other side of that. But they're not doing that. So I want to go on record and say absolutely we should be raising rates right now. But as I said, the Fed is blinded by their labor economist viewpoint. They're going to continue to raise interest rates slowly until the collapse occurs.
I want to ask you now about the bond bull market. Do you think it already ended, like Bill Gross and Jeff Gundlach have said in 2016?
Well, I wrote a book about the coming bond market collapse. Eventually, what's going to happen, and it's going to happen, it's going to happen later than even I predicted, but we're going to have a bond bull market continue, and it's going to continue into this recession. So the recession is going to become manifest, as I said, my projection. I'm not God. I'm just making my best estimate based on the data. Sometime in late 2017 or early 2018. Could happen earlier, it could happen a little later. But when that occurs, there's going to be a lot of fear out there, and people will be running into the dollar and U.S. Treasuries. But on the other side of that is going to be two things. There's going to be a massive increase in deficits. So the deficit is already, as I said, going to be about $1 trillion. But that's before the recession happens. When the recession happens, you have to add about $1.4 trillion because of automatic spending that kicks in when the economy contracts. So you have a huge supply of treasuries coming online, and at the same time you have these huge supply of treasuries coming online, you're going to have a reversal from the Federal Reserve, which is going to be quantitative easing part 2. But this quantitative easing is going to be much more inflationary than the prior. Now, the Fed will learn a lesson, I believe, in that QE really didn't work. So if we have a recession at the end of 2017 or early 2018, the Fed's going to say, listen, the three QE programs were not effective in bringing the economy out of a recession and achieving what they call escape velocity. So the next recession is going to bring about what I believe is helicopter money, which is the direct transfer of Fed credit to the public outside of the banking system. So you remember in 2000, when they started the first QE program in 2009, 2010, that the Fed purchased, Ben Bernanke purchased assets that were held inside the primary dealers. And it was up to them if they wanted to buy other assets and expand the money supply. But the next recession is not only going to see a huge increase in deficits, which is going to cause the bond market to believe that, or at least come to the realization that the U.S. government is insolvent, but the next recession will also bring helicopter money and a huge increase in both money supply and velocity, which should send bond yields absolutely soaring.
And Michael, we have just massive amounts. Not the Federal Reserve has obviously slowed down on their QE programs, and you think they're going to restart it in the near future. But there's been massive increases in QE by the European Central Bank, the Bank of Japan, the Bank of England. $1.5 trillion a year in asset purchases so far in 2017 from the other central banks. It's really dystopian how much assets all these central bankers own.
Yeah, and the interesting part about that, and again to reemphasize my prior point, is this all the QE programs you mentioned outside of Japan, which the Bank of Japan will buy ETFs. So, but outside of the Bank of Japan, all of the QE primarily, and UE and the European, the ECB does buy some corporate bonds, but it's using the conduit of the banking system. And that's why you see asset prices up, and the middle class is like, where's my income growth? Where's the economic growth? It's not happening.
Wall Street for Main Street needs your help. YouTube stole $7,200 from Wall Street for Main Street in annualized YouTube AdWords revenues, and they kneecapped our analytics down by more than 80% across the board since September 2016 with their new censorship algorithms to stop the rapid growth of our channel. That was money we could have used to upgrade our website, pay bills, and invest in improving our content and growing our business. Our audience of loyal listeners is all over the globe and so large now that if most or all of our listeners were to commit to donating $1 to $5 each month to our Patreon account, we could easily meet our goal on Patreon. Wall Street for Main Street also accepts one-time donations on our main wallstreetformainstreet.com website. That's WALLSTFORMAINST.com website via PayPal, Gold Money, or Bitcoin. We also accept donations of physical precious metals that can be mailed to us. Thanks to all listeners who have already made a donation, and thanks in advance to any listeners who make a future donation or contribution to the growth, improvement, and success of Wall Street for Main Street.